Hey everyone, and welcome. So today we're going to talk about something that can sound a little scary, risk. But you know what? It doesn't have to be. We're going to break it all down and build a super practical toolkit that you can use to navigate all those uncertainties life throws at you with way more confidence. So let's jump right in. All right, so here's our roadmap. First, we're going to figure out what risk actually is. Then, we'll build your very own management toolkit. After that, we'll see how those tools work against the three biggest risks we all face. We'll also see where insurance fits into the whole picture, and then we'll wrap up with the key takeaways you really need to know.
Okay, first things first. Before we can even think about managing risk, we all need to be on the same page about what it even means. So let's pull back the curtain on this concept.
So I want you to just think for a second. When you hear that word risk, what's the first thing that pops into your head? Maybe a stock market dive, a car crash? Well, as we're about to find out, that's really not the whole story.
And here it is, the key difference. Risk isn't the bad thing actually happening. No, it's the uncertainty that it could happen. Think about it. A house fire itself isn't the risk. The chance of a house fire, that's the risk. And honestly, this simple little shift in how you see it, it's the foundation for literally everything else we're going to talk about.
You know, this one distinction is exactly why you can get insurance for your house, but you can't for your stock portfolio. See, insurance only deals with what's called pure risk, where the only two outcomes are a loss or no loss. There's zero chance for a gain. Speculative risk, on the other hand, like investing in stocks, has that potential upside, and that's a gamble that insurance companies are just not going to take.
Okay, let's break this down even further. Every risk has a what and a why. The peril, that's the what. It's the event that causes the loss, the actual fire or the car accident. The hazard is the why. It's the condition that makes that loss more likely to happen, like having faulty wiring or bald tires. You really have to get both to manage the risk effectively.
All right, now that we've got our definitions locked in, we know what risk, peril, and hazard are, we can finally start building our toolkit. These are the core strategies for actually managing all this stuff.
And honestly, it all boils down to just three main methods. That's it. You can try to control the loss, you can transfer the risk to somebody else, or you can decide to finance the loss yourself. Control, transfer, or finance. Pretty much every decision we make about risk fits into one of those three buckets.
So let's zoom in on that first one, loss control. There are a few ways to do this. You can just avoid the risk completely. If you're worried about motorcycle accidents, well, you just don't buy a motorcycle. Simple. Or you can use prevention to make the loss less likely. That's like installing smoke alarms. And then there's reduction, which makes the loss less bad if it does happen. A perfect example, a seatbelt. It won't prevent the crash, but it'll reduce the severity.
Okay, tool number 2 is risk transfer. And this is probably the one you're most familiar with because it's the whole idea behind insurance. You're paying a small, known amount of money, your premium, to hand off a potentially huge, unknown financial risk to someone else. It's brilliant, really. You're basically trading a giant question mark for a predictable bill.
And our last tool is risk financing, which is also called risk retention. Now, this isn't about just sticking your head in the sand and ignoring a risk. Not at all. It's about making a conscious, informed decision to handle the cost yourself. You look at a potential loss and you say, you know what? I can cover that. I've got this. It's actually a super powerful and honestly often overlooked financial strategy.
All right, toolkit assembled. We've got our three strategies. So now, let's put them to work. We're going to apply them to the three big categories of risk that, let's be real, every single one of us deals with in our lives.
So here they are: personal, property, and liability. Personal risks, these are the things that could impact your ability to earn an income. Think death, disability, or a major health issue. Property risks, that's pretty straightforward. It's the risk of losing your stuff. And then there's liability, and that's the risk of being held financially on the hook for accidentally harming someone else or their things.
Now, when we're talking about your property, it's so important to realize there are two types of loss. There's the direct loss, which is obvious, the fire burns down your kitchen. But then there's the indirect loss, which is the financial fallout from that direct loss. It's the money you have to spend on a hotel and restaurants while your kitchen is being rebuilt. It's a real cost, and so many people forget to even think about it.
Okay, now let's switch gears to liability risk, and I've got a question for you. If your house burns down, what's the most money you could possibly lose? It's the value of the house, right? It's a fixed number. But what about liability? If you're found liable for something, what is the absolute maximum potential loss you could face? Think about that for a second.
The answer is, there is no limit. It's infinite. A court can award a judgment against you for any amount of money, and that is why liability risk is often called the wealth destroyer. It is the one risk out there with truly unlimited financial consequences.
Okay, let's bring all these ideas together now. I want to show you how these toolkit strategies pop up in something we've all probably dealt with, an insurance deductible.
What you're looking at here is a fundamental trade-off in the world of insurance. It's pretty simple. When you choose a higher deductible, you're basically saying, hey, I'll cover more of the cost myself if something bad happens. And in exchange for you taking on that bigger piece of the risk, the insurance company rewards you with a lower premium. It's a seesaw.
And here it is. This is where it all clicks back to our toolkit. Choosing a deductible is risk retention. That's the tool you're using. It's you making an active choice to self-insure for the smaller hits. You're essentially telling the insurance company, look, I can handle the small stuff. You guys just be there for the big, catastrophic stuff.
Wow, we have covered a ton of ground, haven't we? From the basic definitions all the way to how it works in the real world. So let's boil it all down and lock in the most important things to remember.
Okay, so if you remember nothing else, remember these key points. First, insurance is your tool for risk transfer. Second, deductibles are your tool for risk retention. Third, you can only insure against pure risk, the kind with no possible upside. And finally, and this one is crucial, never, ever forget that liability risk has a potentially unlimited downside. Really getting these ideas in your head? It empowers you to make so many smarter decisions.
So let's end with this thought. You now have the toolkit, right? Loss control, risk transfer, and risk retention. So I want you to think about it. What's one risk in your life, it could be big or small, that you're going to look at differently now? What's one thing you can manage more intentionally, starting today, using these tools?